So as of this writing, which was December 9th, the typical 60% stocks and 40% bond portfolio was down almost minus 15% year to date in 2022. This makes 2022 one of the worst 5 years for a balanced portfolio like this. Take a look at the chart from Lombard Odier showing how bad and rare 2022 has been for this well-known retirement planning strategy. How bad was the loss sustained by your 60-40 portfolio through the third quarter of 2022? Looking at calendar year returns dating back to the mid-1920s, the loss ranks second all time. The first 3 quarters of 2022, the losses experienced in the traditional balanced portfolio were greater than any year since 1931. I'm Chris Parrish, Chief Investment Officer at Oak Harvest Financial Group. And those who know me know I'm a huge college basketball fan. ACC all the way. With the holidays quickly approaching, got the jacket on, I want to leave my viewers with a little holiday gift. I'm going to combine a little stock market history with one of the most moving and inspirational speeches I've ever heard in my life. The speech was given by legendary NCC men's head basketball coach, Jim Valvano. It was his speech at the 1993 ESPY Awards.
Don't give up. Don't ever give up. And that's what I'm going to try to do. Every minute that I have left, I will thank God for the day and the moment I have. And if you see me, smile and maybe give me a hug, because that's important to me too.
He was accepting the Arthur Ashe Award for Courage, as Jimmy V was in the late stage of his life fighting cancer. This speech is better known as the Don't Give Up, Don't Ever Give Up speech, and is used at this time of the year to promote cancer fundraising for research. I'll put a link to the speech in the description below. A warning, have some Kleenex handy. It'll put life into perspective. Don't give up, don't ever give up. Those are Jim Valvano's words of determination, and those are fighting words. Clearly, my job here as CIO at Oak Harvest isn't as important as someone's fight against cancer. Not a chance. Not on your life, not on my life, not on anyone's. It isn't. However, after a volatile and negative year in the financial markets, and for sure, 2022 has been a trying year across both stocks and bonds, many retirees and near retirees might feel like it's just time to give up and pull the plug, particularly on their 60-40 allocation, and go to cash. I'm here to dissuade you from doing this and message that it's probably a better chance now to allocate more to a 60-40 portfolio for almost anyone, regardless of retirement age, than it has been in a couple of decades. Here are the annual returns for a 60-40 portfolio going back 94 years to 1928 and the Great Depression. The data table includes this year's stock returns, the bond component, and then the 60-40 blended return. Looking at the table, most of the worst years for a 60-40 portfolio are in the same years as the worst years for the US stock market. This makes sense since 60% stocks carry much more risk and volatility than 40% bonds. The rarity of 2022 was that both stock and bond market returns have been very negative. Bonds usually provide stability in a portfolio. They didn't do that year to date. Bonds didn't produce any ballast and help you balance what is supposed to be a balanced in a lower volatility 60-40 strategy. And as of the table being printed on October 31st, the bad returns in stocks and bonds were almost exactly the same negative return, about minus 18% each, back near the lows in stocks and highs in treasury yields. This was the second worst balanced 60-40 portfolio performance in the last 90 years. Only 1931, which was during the Great Depression, was worse. So sell it all. Call your advisors and dump it.
They're selling, Mortimer.
Well, that's ridiculous.
Idiot! Get back in there at once and sell!
Many strategies on TV are now parroting that for you to scrap your 60-40 strategy. I'm going to disagree. Now, don't get me wrong, it's been a dog this year. But that's largely because the bond component didn't provide you stability. Bond price declines as yields rise. During the COVID swoon, the Federal Reserve suppressed interest rates to stimulate the economy. Yields during COVID paid you almost nothing, say 2 to 3% in 2020 and 21. Now those bonds are yielding 4 to 9% now, depending on maturities and credit quality of the 40% bonds you might be allocated to. But you've taken a beating this year as yields rose, the price of your bonds declined, as they are inversely correlated over shorter holding periods. Don't blow it out. Why, you ask? Because investing is about longer-term expected returns, and the longer-term data for a 60-40 portfolio looks better now that interest rates have finally risen off the mat. Take a look at the table for 5-year returns of a 60-40 portfolio. On only 4 occasions over the last 94 years was a 60-40 portfolio negative over 5 years, and 3 of those time periods were during the Great Depression. Longer term, 10-year returns, what do they look like? The 60-40 portfolio has never had a negative 10-year nominal return. That's impressive. And even with how bad 2022 has been. As of December 8th, the 60-40 benchmark down minus 14.75% year to date, and the max drawdown for the year being October 13th, that was down almost minus 22%. The 10-year return of a 60-40 portfolio remains over 8% per year. If 10 years ago, exiting the great financial crisis, someone told you as an investor that you would average over positive 8% per year, being only 60% invested in stocks and 40% in bonds, including having a minus 35% drawdown in your stocks in the year 8 and minus 11% in bonds, and minus 17.5% in stocks in year 10, I would hope most investors would be happy. If you weren't happy, you're being unrealistic and you have unrealistic expectations about being invested in public markets. If you want to extend the holding period to 20 years, the annual return of the worst 20-year average between a positive 3.5% and a 6% gain annually, including the great financial crisis and the dot-com bubbles crashing, those returns still seem like an impressive annual return. Moreover, the strategy bested inflation over that period. Now, past performance is no guarantee of future returns, of course. That's the usual disclaimer. It implies to investing, not trading. It's often best to zoom out when you've had a bad year. Extend your time horizon. Look at the forest, not the trees, and don't give up. Don't ever give up. 2022 has been the most challenging investment environment for owners of stocks and bonds, and owners of both in decades. The 60-40 balanced retirement portfolio has experienced losses not seen since 1931. But our Oak Harvest investment team sees reason for optimism, looking at expected forward returns from this strategy. Data provided by Chris Gallipo, senior market strategist at Putnam Investment, shows that when both stocks and bonds are trading below their 3-year moving average, as they were in October, the average forward return 1 year later for a 60-40 portfolio has been positive 19%. In addition, the forward return has been positive 100% of the time. It has been 10 for 10. While the future is always uncertain in investing, history says that now could be an attractive time to once again consider a traditional 60-40 portfolio, or if you're already invested in this strategy, add to your existing positions in this long-term strategy. Our investment team at Oak Harvest recommends that you get on the phone and give our Oak Harvest concierge team a call and ask to speak to one of our financial advisors and planners. Set up a meeting, sit down with our team, and let us walk you through your retirement plan. Give us a call at 877-896-0040 and give our financial planning team a chance to model your cash needs and maybe a few of your greeds too, into and through your retirement years. I'm Chris Paris, CIO at Oak Harvest, and from the whole team here, have a great holiday season, and I hope each and every one of you gets a chance this holiday season to laugh, to think, and to have your emotions move you to tears with your friends and your family, just like Jim Valvano said in his speech.